Welcome to AEON REIT's financial results presentation for the 26th fiscal period ended January 31, 2026. The 6 months from August 1, 2025 to January 31, 2026. Without further ado, I will begin by commenting on the Investment Corporation's financial results and draw your attention to page 5. For the fiscal period under review, AEON REIT's distribution per unit, or DPU, came in at 3,400 yen, in line with forecasts. Meanwhile, the Investment Corporation's earnings per unit, or EPU, came in at 3,244 yen, up 145 yen compared with initial forecasts. This reflects successful steps to control various costs. Turning to the next page, I would like to elaborate on the difference between AEON REIT's actual and forecast DPU. As far as operating revenue is concerned, foreign currency gains on overseas properties had a positive impact on DPU of 20 yen. From an operating expense perspective, the impact on DPU was 116 yen higher than expected. This was primarily due to the decrease in repair and maintenance expenses resulting from the allocation of construction costs to CapEx. Turning to non-operating income and expenses, DPU was positively impacted 29 yen. This largely reflects the posting of interest received and the decrease in interest paid, following the repayment of interest-bearing debt totaling 6 billion yen. In the fiscal period under review, AEON REIT also posted both extraordinary income and an extraordinary loss in connection with Typhoon 12, which hit Japan in August last year, and the earthquake in eastern Shimane Prefecture that occurred in January 2026. Accounting for the difference between restoration and construction costs and insurance claims received, DPU was negatively impacted 21 yen. Taking into consideration each of the aforementioned, net income per unit was 3,244 yen, up 145 yen compared with forecasts. Next, I would like to comment on distribution in excess of earnings. Turning to that portion of AEON REIT's portfolio that is comprised of fixed-term leasehold properties held for business purposes, the distribution in excess of earnings attributable to the allowance for temporary difference adjustment came to 37 yen. This comprised a discrepancy in tax and accounting profit due to leasehold, amortization, etc., and a discrepancy in tax and accounting profit from the overseas treatment of an SPC arising from the consolidated taxation system for foreign subsidiaries related to SPCs. AEON REIT's other distribution in excess of earnings totaled 119 yen. This comprised a difference between the Investment Corporation's extraordinary income and extraordinary loss of 21 yen in connection with the previously mentioned typhoon and earthquake, and 98 yen for construction work to maintain and improve property functions. Directing you to page 7, I would like to touch briefly on topics for the 26th fiscal period. In the fiscal period under review, AEON REIT secured an increase in rent in its bid to improve profitability over the medium to long term. To this end, the Investment Corporation undertook revitalization work to maintain and enhance the competitiveness and functionality of properties. Beginning with large-scale renewal work at AEON Sagamihara Shopping Center, AEON REIT undertook investments totaling approximately 800 million yen, which has in turn led to an increase in rent of 59 million yen on an annual basis. AEON REIT's average rent growth, or return on investment, over the period from its IPO to the previous 25th fiscal period is 6.5%. At 7.4%, the Investment Corporation's rent growth, or return on investment in the 26th fiscal period, represents a higher return compared with the past. At the right side of the page, we provide details of rent increases for overseas properties. AEON REIT maintains contracts for its overseas properties that link rent revisions to the CPI once every 3 years. The rent revision for AEON Mall Seremban 2 took place in September 2025. Compared with the revision 3 years ago, rents increased 5.2%, or approximately 780,000 ringgits on an annual basis. This equates to an increase of around 30 million yen based on the exchange rate as of January 31, 2026, and an upswing of 16.8% compared with rent levels at the time of acquisition 10 years ago. At the same time, AEON Mall Seremban 2 is owned through an overseas SPC. As such, revenues are recognised upon the receipt of dividends and posted in the following fiscal period. Based on the aforementioned, the rent revision in this instance will accrue from the 27th fiscal period. Here on page 8, we take a look at the Investment Corporation's finance and sustainability activities. Turning first to AEON REIT's finances, the Investment Corporation takes steps to refinance a portion of its debt every October. In the fiscal period under review, AEON REIT used 6 billion yen of cash on hand to repay interest-bearing debt while refinancing 23.7 billion yen. As I am sure you are all well aware, interest rates continue to rise. By managing costs through the partial repayment of interest-bearing debt, the Investment Corporation has successfully secured all of its funding on a long-term fixed interest rate basis. As such, the long-term fixed interest rate ratio came in at 100% as of the end of the 26th fiscal period. Moving on, I would like to touch on the Investment Corporation's sustainability activities. At the time of refinancing in October 2025, AEON REIT procured green loans totaling 2 billion yen. In utilizing a joint monetary trust, the Investment Corporation has not only attracted investors with a strong interest in addressing ESG concerns, but also helped control funding costs. In addition, successful steps were taken to recertify 5 properties under the DBJ Green Building certification system. Of this total, 4 properties received the highest 5-star rating, while 2 properties saw their rating improve. Directing you to page 9, we provide a summary of portfolio indicators for the 26th fiscal period. AEON REIT's net operating income, or NOI yield, before and after depreciation, came in at 5.9% and 3.7% respectively for the 26th fiscal period. The Investment Corporation's unrealized gain totaled 99.9 billion yen, an increase of 1.4 billion yen compared with the 25th fiscal period, and its net asset value, or NAV per unit, climbed 654 yen to 160,083 yen. Owing to the partial repayment of interest-bearing debt, AEON REIT's loan-to-value, or LTV, including deposits, edged down from 45.7% in the 25th fiscal period to 45% in the fiscal period under review. For reference purposes, the Investment Corporation's LTV, including deposits, on a market value basis was 36.8%. Moving forward, AEON REIT remains committed to securing high profitability and maintaining financial soundness in the conduct of its operations. While I will elaborate on our current progress toward achieving the midterm targets outlined on page 10, this concludes our summary of financial results for the 26th fiscal period. Next, I would like to comment on performance forecasts for the 27th and 28th fiscal period. Please turn to page 12. Operating income in the 27th fiscal period is projected to increase 127 million yen compared with the fiscal period under review. This largely reflects contributions from the rent revision at AEON Mall Seremban 2 mentioned a moment ago, and efforts to contain costs through a review of construction plans and a thorough examination of repair and maintenance expenses, as well as depreciation. Taking into account the budget amount for interest income coupled with a decrease in borrowing costs attributable to the partial repayment of interest-bearing debt, both ordinary income and net income are expected to improve 206 million yen. As a result, the forecast EPU for the 27th fiscal period is 2,801 yen, an increase of 98 yen. AEON REIT's distribution in excess of earnings is anticipated to come in at 589 yen, down 98 yen, with DPU unchanged at 3,390 yen. Turning to the 28th fiscal period, operating income is projected to increase 371 million yen compared with the 27th fiscal period. This is primarily due to the full fiscal period contribution from the rent revision at AEON Mall Seremban 2 and a decrease in repair and maintenance expenses owing to the completion of work to solidify and improve the ground at AEON Lake Town, scheduled for the 27th fiscal period. From a non-operating expense perspective, the Investment Corporation undertook a review of its funding costs in anticipation of an upswing in interest rates leading up to its refinancing in October. While non-operating expenses are expected to climb 187 million yen compared with the 27th fiscal period, the increase in operating income is projected to more than offset this amount. Taking into account each of the aforementioned, both ordinary income and net income are forecast to increase 174 million yen. Despite an anticipated increase in EPU of 84 yen compared with the previous fiscal period, DPU is projected to decrease 230 yen to 3,160 yen following a review of our distribution in excess of earnings policy. Please turn to page 13. AEON REIT disclosed details of its midterm targets some 3.5 years ago at the time of its financial results announcement for the 19th fiscal period. Leveraging its stable earnings structure, a defining feature of the investment corporation, AEON REIT has steadily increased its DPU through various means, including the acquisition of properties and application of cash on hand. Having said this, rising inflation and interest rates that continue to drive up costs are undeniably a significant headwind that hinders the investment corporation's medium to long-term growth. With this in mind, we recognize that AEON REIT currently stands at a turning point as it looks to enter its next phase of growth. Rather than simply engage in established operations, we therefore acknowledge the need to consider this evolving environment. For this reason, we have positioned the 2 years up to the 30th fiscal period as a period for strengthening our platform for sustainable growth and reviewing our earnings structure. Although we mentioned that we would review our midterm targets at the appropriate time when announcing details of financial results for the previous fiscal period, we will not be conducting a review at this time. By reviewing its earnings structure and reinforcing its resilience to changes in the external environment, AEON REIT will continue to grow while working diligently to achieve its targets. Here on page 14, we provide details of our review of the Investment Corporation's distribution policy. To date, AEON REIT has undertaken 2 types of distribution in excess of earnings. One entails a portion that does not lower capital and addresses tax and accounting profit discrepancies arising from the amortization of fixed-term leasehold properties held for business purposes, and the treatment of overseas SPCs under the so-called Controlled Foreign Currency or CFC tax system. The other entails a distribution with a decrease in investment capital under tax laws, identified in this slide as dividend in excess of earnings per unit. AEON REIT has undertaken distributions in excess of earnings to maintain announced distribution amounts when the events presented at the bottom right of the page occur. However, as these distributions in excess of earnings have recently followed an upward trend, necessitating the increased use of cash in an unsustainable manner, we will undertake a review over the 28th to the 30th fiscal period, which marks the end of efforts aimed at strengthening our platform for sustainable growth. In specific terms, the dividend in excess of earnings per unit amount will, in principle, be set at approximately 10% of depreciation. However, we will utilize funds separately to cover one-off expenses due to such contingencies as natural disasters. AEON REIT's forecast DPU of 3,390 yen for the 27th fiscal period is in line with its previous policy. The forecast DPU of 3,160 yen for the 28th fiscal period is based on the new policy. Turning to the next page, we provide a snapshot of the share of free cash flow to depreciation. Depreciation exceeds 5 billion yen each fiscal period. AEON REIT undertakes distributions in excess of earnings after engaging in essential capital investments. Under these circumstances, free cash flow has followed a downward trend in the 26th and 27th fiscal periods. Conscious of the need to secure free cash flow for future growth, AEON REIT will curb distributions in excess of earnings. Next, I would like to comment on inflation and interest rates, which are key issues for the investment corporation. Please turn to page 16. Directing your attention to the left of the page, we provide details of the upswing in construction costs. In addition to rising unit costs of construction due to inflation, repair and maintenance expenses as well as capital investments are increasing as the number of construction projects grows owing to the aging of properties. The data at the right of the page illustrates the impact of interest rates. While plans are in place to refinance borrowings to the tune of 20 to 30 billion yen in October each year, much of this debt was procured during a period of low interest rates. As such, we are anticipating a certain impact. Here on page 17, we provide a comparison between AEON REIT's cost structure at the time midterm targets were set and a breakdown of costs as of the 26th fiscal period. AEON REIT receives taxes and dues as well as utilities through variable rents. Neither is affected by inflation, and the impact as such, costs as business as well as SG&A expenses, is currently minimal. In contrast, the share of interest payments as well as repair and maintenance expenses continue to climb. Significantly impacted by inflation, these costs are also becoming increasingly difficult to manage. Moving on to page 18, I would like to comment on initiatives aimed at strengthening our platform for sustainable growth. Over the next 2 years, AEON REIT will strengthen initiatives aimed at addressing the issue of rising costs. Our goal is to evolve into a REIT that is capable of renewed growth. As far as increases in property investments, including repairs and maintenance, as well as capital expenditures are concerned, we will work to control or stabilize costs by selecting investments more carefully based on the characteristics of each property. In addition, we will pursue medium to long-term DPU growth by divesting or replacing properties where costs are projected to increase in the future. We also recognize the need to review how contracts are structured. Long-term fixed master lease contracts make it difficult to address sudden upswings in costs. With this in mind, our goal is to evolve into a REIT that can succeed within the business environment by improving NOI. In a bid to address the upswing in interest rates, AEON REIT will consider procuring funds on a short-term and variable interest rate basis in accordance with prevailing conditions. The average fixed interest debt ratio for J-REITs currently stands at 83.7% and continues to decline each year. Against this backdrop, AEON REIT maintains a ratio of 100%. We believe the opportunity exists to flexibly manage costs by refinancing a portion of the investment corporation's debt on a variable interest rate basis. By reviewing and implementing these initiatives over the next 2 years, we will work diligently to secure medium to long-term DPU growth. This concludes my explanation of AEON REIT's financial results for the 26th fiscal period. Thank you for your interest and attention today.